So where were we? We're looking to kind of react and see what we're gonna get today. So we're eyeing this area to look for a break, or we're looking for it to reject here. So I was saying that the market is full of discretionary choices. The reason you guys may see me on these higher time frames is that it gives me the opportunity to make those decisions. So you see it's a big wave going around where everybody's kind of on these lower time frames, which is gravy. You can produce on these as well, but you're not having enough time to make discretionary choices. So I may give you guys a markup. We may look at a markup, something like this. So I may tell people my take profit area could be up here. We're looking to take our money up here. But then the market does something like this. Comes up. It retests. It comes up. Gives us one more higher high. It doesn't hit my target and then it does this. So this is where I'm speaking about making discretionary choices. So when you see your money, like it's pretty much up here, it's a good idea to move your stop loss up, or you can go ahead and cash out your profits. No one can 100% of the time correctly guess where the market is going to go. We make educated decisions, and then where trading is going to be won is going to be with this right here, our trading plan. So if you guys don't have a trading plan, I'm going to send this out to the group, and you guys could copy this one. And you want to go through the market, you want to be asking yourself different questions as you're trading. You want to be asking yourself these questions like, how do I get in? How much do I risk? How do I get out? It's an unpopular opinion, but I tell you guys, there's no red light, green light system in trading. So no matter what indicators, they're going to only give us indications. No matter what system you have, there's no way to like just buy here, sell here. If it was that easy, then everybody would be millionaires. Everybody would just trade. If we can just simply be like, okay, an indicator told me to sell here and to buy here. Unfortunately, it's not that easy. But you can put what we call an edge on your side. So you have an edge over the market, and we're going to exploit that edge. So we can get you guys with a system or a strategy that works, let's say 60% of the time. Well, now you got a 10% edge over the market, and we can work with that because we know 10% of the time out of that 100 set, we know that we're going to have a 60% win rate. So now it's just a matter of doing the numbers and doing the same exact thing in the same way. So at the end of the week, we're going to be profitable. Now, a lot of people don't like to hear the concepts. They want to more know about the technicals. So I'm going to dive into some technicals for you guys. The way I look at the chart is I'm starting on the day chart. These are going to give me better indications of where the trend's going and where the market possibly could go. Then I'm working my way down so I can actually enter the market. I'm getting a lot of information from these day charts as far as where price has already been. So I say this pretty often. We start in the present. We look in the past to kind of figure out where the market's going to go so we can trade this part that hasn't happened yet. So if I see something like this, I pull up a chart. I'm looking at the chart. I may make it a little small. I want to see which way has the chart been going. Okay, I was showing this big down move. Now I'm showing it coming up. So what I can do is I'm just really placing spots to where I want to trade or where I want to take account of. The technicals are not the hard part of trading. A lot of people are too zoomed in. They're on too small of time frames, and they're making it a lot harder than what it is. The only thing I'm doing is just looking at spots where the price has been and where it could go. So I know, okay, price was here. When I look in the past, it stopped here. That's telling me something. That's telling me there's something sitting here stopping the market. So I'm not really a betting man, but if I was a betting man, what would I say? I put my money that the market, when it gets here, is going to stop again. That could either be your target, your take profit. So if you got to buy here, you already know where would price go. You're going to be looking for the area where it stopped it. Significant stop. So we're looking at this market as a whole. We see overall it's been going down. We got a little bit of a retrace. The market can never just go all the way down like that. It has to go down. It breathes a little bit, go down. It breathes a little bit, goes down, takes a breath, big breath here, like getting tired, drops real heavy, taking another breath. So the way we look at it is, some of you may be familiar with the running man concept, which we look at price like someone running with a rubber band attached around him. So we look at him. He got here. He started the race. He ran, took a short breath. He ran again, took another short breath. It's kind of just stalling at the starting point. Take another run. Now this time he took a very, very long rest. The rubber band pulled him all the way back up. He barely even beat his previous lap. That's going to be a key sign that maybe he's getting kind of wore out. It's going to be a key sign that I don't want to go too heavy with selling. Now, even though this did push down real heavy, this was based on different factors in the news. We got the corona, we got different things, so it's kind of sporadic. But if you guys will start looking at these runs similar to what they are, they're just runs. He's taking a rest, he's taking a run, he's taking a rest. If he starts resting more, then hey, that's an indication, that's a sign to get out the market or not to sell as heavy. So now that we know kind of like a concept of him running, all we want to add, on top of this is just his lap areas, where the checker flags would be. So I see here, look at all these people, marathon runners, kind of right in this area. That's significant. That lets me know that's kind of like a rest stop up here. So when price gets up here, I can expect it to kind of stay in this area for a while, just like it's been doing all in the past. So you start off with the time frames, the higher time frames, and you're gonna start putting your key areas of interest. So you guys see now I got highlighted areas to where I'm not just trading anywhere. I want to trade when I see these areas because I know the price is gonna do something. It's gonna stop. It's gonna give me like a little hesitation, and that gives me time to interact in the market. So even if I see a setup, like I see something like an engulfing candle, a some type of price action like a head and shoulders, a a harmonic, anything like that, I won't take the trade if it's down here, even though it gave me a big move up. I'm not looking to just trade just because. I'm looking because I want to make, defined trades based on some type of reasoning. Just because it gives me a signal, whether I'm using, indicators, I can be using this indicator and it could give me a signal to sell. But it's not even nowhere near my levels. So to me, that's no man's land. I could come here and draw some more levels, but I don't want to make my trading too complicated. So I'm just going to wait. I'm just going to pass this chart and I'm going to go to another chart. Now, since price is here, it's at a level. It's a level that I'm familiar with. So I know it's decision time for the market. Now I want to figure out, how do I get into this trade? Do I want to take the trade up? Do I want to take the trade down? To do that, to figure that out, I'm gonna come to a smaller time frame. Now that I'm on a smaller time frame, I'm looking at, okay, every time it hits this ceiling, it's dropping off. Hitting that ceiling is dropping off. Hitting that ceiling is dropping off. It's pushed back up to the ceiling. So now I'm more like, okay, what do I want to do? Do I want to buy it or sell it? I have been getting some up momentum. Now this is where you can add in your indicators if you like to use indicators. Bam. It's at the top of the Bollinger Band. It's pushing down. This line here is like a line in the sand. If I see it break here, of course I want to sell it. I'm going to sell this. Where do I want to take my profit? I can either use the indicator and take my profit here, or I can use price action, and now I can find me another zone that I may be interested in taking price to. So now I see down here, price gave me a wick right here. It gives me wicks right here. It doesn't really want to move right here. There's something here that's stopping the market. So if I was selling, this is where I'm going to be looking to take my money at. No matter what the market does, this is a higher time frame. Each one of them is a full day. So when I go to the 4-hour or smaller time frame, I'm not going to see a straight drop. I'm going to see up and down, up and down, up and down. See how much more room. So price is going to do something like this. I'm going to get a drop. Move back up to retest. Potentially. Another drop. Move back up. Or retrace. So on and so on. Until we get down to our target. So now the intricacies of this, and this is a little, I want to say more like a tier 2 type of introduction. But what we're starting to see is we're going to see identification that this uptrend has now turned into a downtrend. So how do we do that? We're going to be looking at a series of higher highs and higher lows. When the market makes a low, it comes back up, retest. It's going to be considered a lower high. Then we get a lower low. Let me mark this off for y'all. So we got a new low. We get a reversal, we'll have a new low. Right here, I'll keep it simple. Just put it there. We have a low. So this is making a series of patterns or formation or what we call market structure to give us a definitive market direction or understanding of what the market's doing. You know, as humans, we like to associate everything with patterns. So this allows us to verify or have a pattern that we can quantify as far as figuring out what price is doing. Then we get another lower high. So after you get a low, a lower high, a lower low, a lower high to a lower low, this is considered a trend change. Now we know that the price is going down. Now, how far down? The safest estimate is going to be where you see price stalling. Now we're getting into structure. We're learning how the market sets up its actual patterns. So if I'm going in and say I missed this first move. I want to have confirmation. I'm one of those people that I want it to be perfect. I want, I'm putting a big lot size. So I want to make sure that I get in at the right exact time. What you want to wait on is for it to form a low, a lower high, get you a lower low, so it breaks the previous structure. If you notice, we're still starting it out right, and we looking to our left, you'll see the similar structure coming up. So you see, we had a high, a lower high, or excuse me, a higher low. We call it a higher low anyway. Came into a high. Now you guys are going to start seeing formations as far as the outer line formation. That's where you get patterns from, like the head and shoulders. So you see the same things happening. The market does kind of the same thing every day. So you have that formation that gave us the highs. We got a high up here off of a zone. If it's the market starts to break, we're going to get a low, a lower high, a lower low, a lower high. Now, once we first get this low, lower high, lower low, it comes back up. If you guys notice, it's going to test the previous zone that was up here above. If I stretch this thing out, bam, you see how the market act as a wall or a ceiling. It kind of tweeted through this ceiling and broke to a new high, but it's still, if you go back, it kind of, there's wicks. There's some type of like roadblock here. So I know when price breaks this area, because it broke it to make a high. So it came into a high, a lower high, and then it broke that area, the ceiling, to make a new high. So when price is coming down, I know where it's going to react. Hence why I'm putting these areas here on the higher time frames, because they're these ceilings and floors that I'm looking at here. So we got to the ceiling. If it breaks down, we got another floor here. It bounced off the floor. It didn't have as much momentum. They didn't throw the ball down hard enough to bounce and break through the ceiling. It just came down, bounced up a little bit, gave us a little triple the force. Now the ball, when it fell down, it's coming down heavier. It broke the floor. Now the ball is going to hit. You don't have to be this intricate, but if you see, when I put this here, this is basically another floor. And when I drew this up, I didn't look at anything. This is just market structure. So it wasn't like I was looking to the right to make sure this matched up. It's crazy how it just matches up because that's how the market moves. So I got a lower low, bounced up. It hit the top ceiling. This is where I want to enter it. The reason why I want to enter to complete the sale is because I know it has something above it that can potentially block price from just going way up. It's not an exact science. Sometimes it may just shoot through here. That's why we use proper risk management and we use stop losses. But the market typically bounces up and it'll reject off this high. That's my entry. I don't want to chase price. I'm not looking when it's coming down. I'm not looking just because it broke here. I'm not looking just to jump in. I want to let price, just like a bank or institution does, I want to wait for a higher price. They don't want to sell at the cheapest price. They wait for price to gain a little bit more value, and then they sell at a higher price because they're getting more for their money. So that's how we have the thing. We let the price come back to us. It's going to come back to pretty much a level that we've been at, and then we sell and we catch this whole leg. Let me say, I think I had a question. Exactly, Carter. I always enter on a. It's a great area, but basically that's what we're doing, entering on a retest. Instead of saying retest, I mainly consider it as allowing price to come to me. So I know already I want to sell, but I don't want to sell while it's selling. That makes sense. I don't want to enter the market while it's selling. I want to enter it while it's coming up. So some of you guys may see some of my trades and you're like, okay, the price is bullish. Why is he selling? It's because I already know that it's been selling. Yeah, we have a retrace, but that's the perfect time to enter the market to catch the high and drop it down. make them give you all your money instead of trying to get in here after it breaks. You ride it down and then they do this, they pull the market up, hit a stop loss, or now you're in drawdown. So that was just a little something that I want to show you guys on market structure. I got the floor open. Like I said, tonight I'm not really just diving into much of one subject. I just want to try to help some people out. I need to. We got about 10 more minutes. I can open the room back up if anybody have any questions. Like, I learn every day, so I know some of you guys may have something that y'all. It don't matter if it's something new. I mean, anything. I'm here to kind of, open book right now. If I don't know, then I'll find out. I mean, the flow open, so I guess everybody here profitable.
Can you hear me?
I got you, brother.
Okay, yeah. I don't know. The one thing, like, I've been looking at it this way for the past few weeks, and at first I was not catching it, and I did good for a while, not catching it on the retest. As soon as it break, I was jumping in, and sometimes I end up in drawdown. Sometimes it'll go in 15, 20 pips up, and I get out before the retrace. But now it seems like I'm not catching any trades. I guess by the time I sit and wait, then by the time I'm like, okay, I'm gonna go take a nap or go to sleep, then I come back and it's, and I get in, then I'm chasing. I'm like, goodness, it's like the trade gods are against me or something. And then now I'm watching it just going sideways. I mean, what is it? And I've tried, you start looking at 2 or 3 different pairs, then that's like it gets to be too much noise. So it's like,
I know you're feeling, bro. I can relate. I done been there. One thing that's gonna help you, my man, is just dial back from the chart. I always tell everybody, like, most of the time, you got to look outside the chart. So you want to take a look into what times you're trying to enter the market. So if like right now is the times you settled and you got time to look at the markets, you want to more focus on like GBP. I mean, not GBP. You want to more focus on Japan pairs, because
right.
those are gonna be the ones that's moving. Now this week has been odd because we've been having all this news pumping through with the corona, the Russians doing their oil stuff. So it's just the market's been kind of really choppy. Now, as far as dialing in and trust me, I done been there, man. It feel like it's like they just after your trades only.
Right.
Yeah, man. But what I would tell you is let me ask you this. So are you using indicators, price action, or a combination of both?
I'm trying some of it all, but I think, I don't know, indicators just seem like the trades that I get into off bear price action, I end up doing better on them. I might not stay on as long as I should, and I may miss the trade, but I choose the trade to go in the direction that the trade generally goes in the direction that I expect it to more. I'll say it like that.
Indeed. So
and the indicators seem like they cause more confusion than anything. So I try to stay away from those, and then I look back on the indicator. Like if I say I'm gonna trade this and do this is what I expect, or this is what my analysis say. Once it goes whatever and does whatever, I can put the indicator on. I'm like, okay, the indicator kind of line up. But if I look at it, it'll start getting me confused, and then it'll help me jump out the trade or something like that.
yeah, my man. I tell you this, man, and hopefully give you a little optimism, man. Just hearing you, the way you trading, you about halfway through the battle, my man. The next step I would say for you to start just seeing the results you're looking for is make sure do you have a trading plan?
Yes.
Okay. I always tell everybody my trading plan is smarter than me. So we want to just live and die by, like, I keep this up every time I trade. So you want to follow, because it becomes nuances. Like you say, you may get out early. You may jump in. So this is gonna keep you just in check as far as your rule base. So I'm gonna be honest with everybody on the call. Like, if somebody tell you that trading is an exact science, they lying. Like, all this is discretionary. The market is, I wouldn't say it's random, but the market is gonna do what it wants to do. Our job is to participate in it, and where the winning is done is based off of things outside of the market. Like, did you follow all your rule base? If you did, and the market does something totally different, then you did your job. So it's trading is not won with one trade. It's over a sample size. So your goal should be like, okay, this week I'm gonna take 10 trades. Out of them 10 trades, I want to shoot for like a 50% win rate. Or we can even go, let's go 20 trades to give you more room on the sample size. You want to try to get, 50%, or really we want to have an edge. So we want to go anywhere from 55 to 60% win rate. So every time you take a trade, you want to keep a record. I got a trading journal somewhere here too. You want to keep a record. Okay, I took GBP USD. I was looking for 30 pips. I got 20 pips out of that. And you just don't keep your check marks going until you hit your 20 pips. So at the end of the week, what's vital is what we call the risk versus reward. So most people, they try to teach you guys to start off with like a 1-to-1. Well, on the backside, when you do the math, that's hard to maintain. I don't care what nobody out there saying. Ain't nobody out here really winning on 80%, 90% of their trades. It's all like gimmicks. So you want to be able to run it like a kind of like a casino. The casino, at the end of the casino, they're gonna always have the edge. Yeah, they're gonna let a couple people win the jackpots. To us, stop losses might hit, but if people keep on trading or keep playing, the edge is gonna be on their end to end up, winning in the long run. So that's where risk management, that's where the trade plan, that's where your risk to reward comes in. Trade less 3 times. So if I'm risking $1, I'm looking to get 3. So I know that's a lot of concept, but to kind of go a quick overview of technicals, no matter what chart I'm on, because the market is what they call fragmented, or excuse me, it's called fractal. So whatever happens on this 1 hour chart is going to translate over eventually to the 4 hour chart, to the daily chart. So from analysis, and I'm looking at the zones, I'm looking at kind of stopped here. I may want to try to take it down to here. Before I enter that trade, I'm looking at the risk profile. And this may take a lot of stress off your trading too, because you're like, okay, so from the next level where I see that rejection right up here. So I know if the market go past this point, ain't nobody there stopping it. You see how usually somebody's up here stopping it. So if I know if it go up here, it's gone. It's gonna shoot up. I'm looking to sell it. So I know if it go down here, somebody can be sitting down here getting ready to buy it. Got a bank or institution down here because you can see them wicking out. So now I want to measure from here to here. Now this probably ain't gonna be a textbook example, but we'll see. So down there is about 72 pips. Up here is about 40 pips. So that's still kind of like a 1-to-1. I'm gonna skip this trade. If I don't skip it, what I'm gonna do is I'm gonna adjust the method that I'm entering. So if I say, hey man, it still look like a real good level, I think it's gonna break. What I'm gonna do is I'm gonna go ahead and instead of having my stop loss so high, I may look down here on a smaller time frame, and I'm seeing if it's giving me any more information before this area. So like now I can see that on the smaller time frame, I do got a closer area, one right here, that where people were starting to sell the market. So now this can probably be my stop loss. It's a tighter stop loss, so it's going to kind of change the probability or giving it enough room. Like, hey, if I want to take this trade, I'm gonna go ahead and lower my lot size. Now I'm looking at, let's see how many pips it is. Now I'm looking at only 23 pips for 70 pips. So that's a 3-to-1. So I'm like, hey, okay, now I'm working something. jump back down to a smaller time frame. Now I just want to wait for an entry. Whether it's gonna be a engulfing candle, if I see the price come up a little bit and give me a wick, I'm at their neck. I'm gonna go ahead and drop my sell. Now, doing it this way,